Hello everyone, welcome to the part 2 of the Financial Stability Report June 2025. Before starting the discussion, I would like to tell you that we have launched the RBI Grade B 2025 preparation kit. So if you are preparing for RBI Grade B examination, this is a free kit for you guys. Link is there in the description, you can subscribe to it. So you'll be getting complete guide here, 100 plus economic and finance terms, RBI Grade B PYQs as well for the last 5 years. You'll be getting budget highlights and MCQs out of it. AIR 1's note is also included in this particular course. There will be 60 plus model tests for ESI and FM, quant and reasoning formula ebook, and 20 plus model essays for your examination. You'll be also getting 500 general awareness MCQs and 120 plus management MCQs. So don't wait, quickly subscribe to this free preparation kit for you guys. That will definitely help you prepare for your examination. You can download our Oliveboard application as well, and you will be getting all the PDFs of all the YouTube sessions on our application. You will be also getting notifications for the sessions. We have launched RBI Grade B course as well. This is a complete course for your phase 1 and phase 2. This is with books. You will be getting physical books as well as you can check the course highlights. Let's quickly start. This is the part 2 of your Financial Stability Report. We have already covered part 1, right? This will be the part 2 of your Financial Stability Report. We'll be discussing about the second chapter in detail, which is Financial Institution Soundness and Resilience. So here we'll be talking about all the financial institutions, how sound they are, how resilient they are. So let's have a quick reading of the core highlights which is there in the report. So the Indian banking sector remain robust with capital buffers at record high. So we can see here that in Indian banking sector, capital buffers are at record high, so that's a good news for Indian banking sector. What do you mean by capital buffer? Usually we call it as CRAR, right? So CRAR is at a record high as of now. Non-performing loans ratios at multi-decadal low. So if I talk about the NPA, NPAs, non-performing loans, GNPAs and net non-performing asset, then in that case the ratios are at a multi-decadal low, so that's on the lowest as of now. This is also a good thing. And improved operational performance. The operational performance of these banks have also increased. Improved macro stress test reaffirms the resilience of the bank. So in the in the Financial Stability Report, they have done a macro stress test as well, right? So in the stress scenario, whether the banking entities are able to remain strong, are they able to even tolerate that kind of stress that is emanating. So we are doing a macro stress test as well, and the results are there in your Financial Stability Report. Again, it reaffirms that the resilience of the banks to the adverse scenarios is quite good. The resilience of the NBFC sector is enhanced by the asset quality and healthy capital buffer. So asset quality of NBFC is also good. Healthy capital buffer is also being maintained, not just in the banking and in the banking entities, but also in the non-banking entities. Interconnectedness among the financial sector entities, as reflected in their bilateral exposure, continued to grow in double digits. So there is always interconnectedness. Whenever a particular situation or a stress is there with a particular bank, it can create a multiplier effect, right? Because all the financial institutions are ultimately interconnected, right? Now let's start the second chapter. We have already discussed about the crux of the second chapter. Now let's try to understand it in detail. So banks and NBFCs reinforce their capital and liquidity buffers. So they have a good amount of capital buffer and liquidity buffer while improving their asset quality, and their asset quality has improved over the period of time. Bank credit growth decelerated and moved closer to the deposit growth. So as of now, the bank credit growth has declined. I'm talking about the credit growth. It has declined and it has moved closer towards the deposit growth. So when the credit growth is falling, that's a problem, because that's the basic business model of a bank is to accept the deposits and to lend them and to give credit, right? So banks is accepting the deposits. There is a growth in the deposit side. So why there is not at all a growth in the credit side? That's a problem for the banks, right? Next, we can see, if I talk about the scheduled commercial bank, then the scheduled commercial banks aggregated deposits grew at 10.7%. So there is a growth in the deposits by 10.7%, irrespective of the deceleration in respect of the private sector banks and foreign banks. Okay, so even though there is a decline in the private sector banks and foreign banks growth rate in terms of deposits, however, overall the scheduled commercial banks aggregate deposits grew by 10.7% as of now. SCBs credit growth decelerated in 24-25. We have already discussed that. Public sector banks, PSBs, outpaced that of private sector banks during the year after more than a decade. So here public sector banks have outperformed private sector banks in terms of the credit growth. So we can see here in the chart as well. Here we are having the deposit growth ka chart. So we can see that in the scheduled commercial banks there is a 10.7% increase, right? Foreign banks there is 9.8%. If I talk about private banks, it is 12.2%, and PSBs are having 9.5%. So I can say in terms of deposits, private sector banks are doing well in the category. If I talk about the credit growth, in that category foreign banks are doing well. However, the public sector banks are doing well as compared to the private sector banks. In public sector banks we can see a credit growth of 12.2%, whereas in private sector bank there is a growth of 8.9% only. So here the public sector bank has outperformed the private sector banks in terms of credit growth, right? So if I talk about the composition of the credit portfolio, what forms in the credit portfolio, whether agriculture, industry, service or what. So we can see that in March 2025 the scheduled commercial bank का सबसे ज़्यादा वाला exposure was the orange portion, which is 33.1% personal loans, right? So the biggest amount in the portfolio is composed of personal loans, then services at 29.8%, right? Then industry and then agriculture. Now if I talk about the asset quality, the GNPA ratio and the NNPA ratio declining to a multi-decadal lows of 2.3% and 0.5%. So if I talk about the GNPA, it's 2.3%. If I talk about the NNPA, it is 0.5%. They are at a multi-decadal low. So that's a good news for the banking sector, right? The provisioning coverage ratio, PCR, how much provision you are able to make, right? Let's suppose you are required to make 100 rupee worth of provision. However, you are having only 70 rupee as provision. So I can say that your PCR is 70%, right? So the provisioning coverage ratio here is of the SCBs, scheduled commercial banks, is at 76.3% in March 2025. So the PCR is 76.3% in March 2025. Okay, do let me know what is the bare minimum limit of PCR. Okay, what should be the bare minimum limit of the PCR? Let me know in the comment section. What do you think? So here if I talk about the SCBs GNPA ratio, then it is at 2.3%. consistently down in a downtrend, right? And that's what we can see in case of foreign banks, in case of private sector banks, in case of public sector banks as well. And here we can see the net NPAs as well. They are also at an all-time low, 0.5 for all the scheduled commercial banks. It's low for foreign banks as well. It's low for private sector banks as well as public sector banks as well, right? If I talk about the half yearly slippage ratio, then again it's at 0.7. okay, so the lowest in the category here is public sector bank. If I try to compare it with the other category, the lowest category here will be public sector banks, right? And what is slippage ratio? It is the percentage of fresh NPAs, right? It is the percentage of fresh NPAs, loans that are turned bad. in a given period of time out of the total standard loans at the beginning of the period. So how many fresh NPAs are there? That's called as slippage ratio. Okay, that's called as slippage ratio. If I talk about the PCR, then we are having 76.3% as PCR for the scheduled commercial banks. The highest PCR is of foreign banks, right? And clearly the public sector banks are outpacing the private sector banks in terms of PCR. Next is the credit quality of the large borrowers. So the credit quality of the large borrowers, those who are borrowing huge amount of money, has improved steadily. Here, right? We can see here the share of the large borrowers in the loans and the GNPAs, right? So if I talk about the GNPAs, it is 37.5% and gross advances it is 43.9%. So GNP ratio of the large borrower has also consistently declined as of now, so that there is always an improvement in the credit cycle, credit side of the large borrowers as well, right? So GNPA's ratio have declined to 3.8%, while the SMA, now what is SMA 1, SMA 0, SMA 2? Before turning a loan into NPA, before the loan gets turned into an NPA, we can still see the sign of stress. We can see the sign of stress. So it's nothing but an early warning signal for us that this loan might turn into a NPA, right? If I talk about the capital adequacy, then in March 2025, the capital to risk weighted asset ratio of the SCBs increased to a record high. So that's again a good thing. We are having adequate capital buffer here. It's at 17.3%. Okay, it's at 17.3%. Now, what do you mean by SMA? It is nothing but special mention accounts, right? So we are able to judge the capacity of the loan, or I will say the quality of the loan earlier itself before turning it into the NPA. Before it gets into the NPA phase, we still can see the sign of stress, right? That's nothing but NPA. Sorry, SMA, special mention account, right? So here there are multiple categories like SMA 0, SMA 1, SMA 2 based on the number of days for which the principal and interest remains overdue. It can be wholly as well as it can be partly as well. So this is a standard asset basically. So when we classify under the SMA, it is still a standard asset. However, there is some kind of stress in it. If it's a regular asset, then no problem at all. However, if there is any kind of stress in it, so we can definitely classify it in SMA 0, SMA 1, SMA 2, and then after 90 days as per the NPA provisioning norms, right? So the increase in the CRAR during the quarter ending March 2025 can be attributed to the higher growth in the capital relative to the growth in the RWA during this period. Now, what is CRAR? CRAR is nothing but capital divided by your risk-weighted assets. So what is the driving reason of such an increase in the CRAR? So the capital has increased as compared to the risk-weighted asset. Risk-weighted assets ratios have not declined as of now. However, the capital has increased. If the numerator has increased, definitely the overall ratio will go up, right? If I talk about the earnings and profitability of the scheduled commercial banks remained strong in 2025 with PAT, profit after tax, increasing by 16.9% year-on-year basis, right? So there is an increase in the PAT by 16.9% year-on-year basis. PAT of public sector banks recorded a robust growth of 31.8%. So PAT of PSBs is quite amazing, 31.8% as compared to the previous growth, right? And public sector banks have outpaced again private sector banks in terms of profitability as well this time. Okay, so PSB's higher profitability was primarily driven by the rise in their other operating income. So because of the rise in the other operating income, PSBs has outperformed the private sector banks. Then there is net interest margin. It declined, was driven due to cost of funds. Okay, so both the return on equity and return on asset ratios have declined in March 2025. Let's first have a look at the chart. So this is the chart of CRAR. For all scheduled commercial banks, it's at 17.3%. Who is maintaining the highest CRAR? As of now, foreign banks are maintaining a highest CRAR. and private sector banks are outperforming the public sector banks in the maintenance of CRAR. So private sector banks are maintaining a CRAR of 18.3% as compared to the public sector bank, which is there at 16.1%. What do you mean by CRAR? Sorry, what do you mean by here the capital adequacy ratio के अंदर जो capital होता है that we take. So there are a lot of components in the capital, right? As per the Basel norms, we need to maintain a minimum CRAR of here 9%, and then we need to have a counter cyclical buffer of 2.5%, right? This is the minimum requirement. So there is CET1 capital, AT1, tier 2 capital, then there is CCB buffer as well, and CCYB buffer as well, which is currently at 0% as of now. So as per the Basel norms, we need to keep this much of CRAR as of now. If I talk about the net interest margin, then net interest margin is on a downtrend, on a slightly downtrend. It's at 3.5%. What do you mean by net interest margin? Look, a bank earns income. How the bank is earning a profit? The bank is taking, let's suppose, loan at 6%, deposits at 6%. Then they are offering the credit at, let's suppose, 10%. So can I say that this 4% is nothing but a profitability or margin for the bank, right? So here we compute the net interest margin. It's at 3.5% as of now. Who is having the highest margin? Private sector banks and foreign banks are having the highest margins. So private sector banks are outpacing the public sector banks in terms of net interest margin as well as, right? Then we are having return on equity. What do you mean by return on equity? As the name says it all, return is on equity. So return divided by my equity. Now if I am computing the return for equity shareholders, what will be the return? Obviously earning which is available for equity shareholders, right? I am computing the return which is there for equity. So I am having profit. I need to pay taxes, I need to pay interest income, I need to pay all the expenses, I need to pay preference dividend as well, and whatever is left is for the equity shareholders. That is profit available for equity shareholders, right? So I'll be taking that profit. That's return on equity. That means the equity shareholders have invested in my company, how much return I am able to generate for them. Return on asset, again as the name says it all, return is on asset. Return divided by asset. I have kept this much of let's suppose 100 rupee of asset in my company and I am able to generate a profit of 20 rupee. Then that means my ROA is 20%. Now what is return here? PAT is the return here. Profit after tax is the return here, right? So if I talk about the ROE, then scheduled commercial banks are having 13.6% as the ROE. If I talk about the public and private sector bank, then public sector banks are outpacing the private sector banks in terms of return on equity. Coming to the return on asset, scheduled commercial banks are having a return on asset of 1.4%, and here private sector banks are outpacing the public sector bank, okay, in terms of return on asset. Coming to the liquidity, then scheduled commercial banks have further improved their liquidity position in March 2025. So their liquidity position is quite sorted as of now. Whenever we talk about liquidity, we talk about liquidity coverage ratio, we talk about net stable funding ratio. So both LCR and NSFR have been comfortably above the regulatory minimum 100%. So 100% is the bare minimum requirement for liquidity coverage ratio and NSFR, right? That is the bare minimum requirement for LCR, liquidity coverage ratio, and net stable funding ratio. So if I talk about the liquidity coverage ratio, it's well above the minimum requirement at 132.6. okay, it is at 132.6, and foreign banks are having the highest liquidity coverage ratio, and public sector banks are outpacing the private sector banks in terms of LCR. So public sector banks are having high amount of liquidity as compared to the private sector banks. Coming to the net stable funding ratio, the scheduled commercial banks are maintaining a net stable funding ratio of 126.3, right? Again the highest in the categories of the foreign banks, and here the public sector banks are outpacing the private sector banks. So both in terms of liquidity, both LCR and NSFR public sector banks are outpacing the private sector banks. However, the regulatory requirement of minimum 100, we have already covered it very well. All the scheduled banks are covering that particular requirement very well, right? So there is no liquidity constraint as of now. Now, what is liquidity coverage ratio? Do you guys have any idea about the liquidity coverage ratio? The aim is to ensure that there is short-term liquidity. There is enough short-term liquidity of the bank. So liquidity coverage ratio is mandated to ensure that bank can promptly respond to any kind of potential liquidity disruption. In case if there is any kind of liquidity issue, bank can promptly resolve that thing, respond to that thing. So we need to maintain here the high quality liquid assets, HQLA, high quality liquid assets, right? That can at least survive acute stress scenario lasting for 30 days. So do we have enough high quality liquid assets that can survive any kind of stress scenario for at least 30 days, So high quality liquid assets are highly liquid assets that can be immediately converted to cash in case if we want to meet any kind of liquidity needs, and that's the formula: high quality liquid asset divided by the net cash outflow over the next 30 days. So it's simple: over the coming 30 days, can we meet our regular net cash outflow? Let's suppose I do have a net cash outflow of 1 lakh rupees. So can I meet it? Right, in the next 30 days I do have a net cash outflow of 1 lakh rupees. So can I meet it by using my high quality liquid assets? So as of now we need it at least 100% or more, right? It should be at least 100%. That's the minimum criteria that RBI has stated. Then there is net stable funding ratio. Net stable funding ratio, as the name says it all, shows us the stability of the funding. So whether we are having enough stable funds or not. So long-term liquidity of the bank is being measured by the NSFR. We have already measured the short-term liquidity in case of liquidity coverage ratio. Now we are just checking the long-term liquidity of the bank, right? So first thing we need to check is available stable funding. How much available stable funding we are having as of now, and then we need to check the required stable funding. The formula will be available stable funding divided by required stable funding. Let's suppose I need 100 rupee as required stable funding. However, I am having only 70 rupees as of now. Available stable funding is 70 only. So I can say that this is as of now 70%, which is below the bare minimum 100, right? So this should also be at least 100% on an ongoing basis. Next is sensitivity analysis. So here we are doing a macro stress test, right? That sensitivity analysis, like how sensitive your parameters are, your bank is, as compared to when I test stress scenarios on multiple factors. It can be GNPA, it can be interest rate, it can be equity prices and deposits, or any other kind of parameter, right? So you'll be checking one by one. If this particular thing changes, let's suppose if interest rate in the market changes, what impact it will have on the performance of a bank? That is nothing but sensitivity analysis, right? So shocks are applied to single factors like GNPA, interest rates and equity prices and deposits, one shock at a time. Okay, so we'll be applying one shock at a time and we'll be checking what will be the resultant, right? How sensitive the things are because of that one particular shock. That's sensitivity analysis, right? So here we can see that credit risk, shocks and outcomes. There you can see that on the baseline the numbers are stable. Okay, so green is the CRAR, yellow is the GNPA, and blue is the CET1 ratio. However, applying the shock first, losses as percentage of the system capital, so we can see that the losses are increasing. Then if we apply shock 2, the losses are drastically increasing. So this kind of study has also been done by the RBI, and they have published it in the Financial Stability Report as well, right? If I talk about the interest rate risk, then there are some of the terminologies that are being mentioned in this particular report, like FVTPL, AFS, HTF. You need to know the full form and the meaning of these terminologies, right? FVTPL means fair value through profit and loss account. AFS means available for sale. HTF means held for trading. Okay, So definitely do research about these terms, please. I have covered it in one of my previous video. I'll be definitely covering it in the coming videos as well. Okay, so here we can see the LCR under the alternate scenarios as well. So in case of baseline scenario, this is the LCR. In case of stress scenario, we can see that LCR is again stable. In case of stress scenario 2, okay, in case of stress scenario 2, which is the blue line, we can see that whenever in case of adverse condition, the LCR keeps on decreasing. The LCR keeps on going down, right? In case of stress scenario 1 and 2 as compared to the baseline. However, we can still notice that even if the stress scenario is there, whether it's stress scenario 1 or 2, LCR is still above the bare minimum of 100, right? So that's a kind of worst case analysis that RBI also do, that stress aa bhi gaya, so whether we are able to manage it or not, whether it's crossing the bare minimum threshold or not, right? So this is the purpose of conducting these stress test scenarios. Okay. Individually, all the banks would be able to maintain LCR above the minimum requirement of 100%. As we can see that all the banks are able to maintain the LCR of bare minimum 100 level. They are way above the 100, right? At least 15 to 16% above the bare minimum of 100. So that's good, right? Even in the stress scenario. Then if I talk about the sensitivity analysis of the small finance bank, then SFBs shows that each SFB would remain resilient under the stress scenario. So small finance banks are also quite resilient even in the stress scenario. That was the conclusion from this report. Income from the derivative portfolio includes changes in the net MTM. Now what do you mean by MTM? MTM means mark to market. Now what is mark to market? Let's suppose you have taken a derivative position for 10 rupees. It went up to 12 rupees. So you are earning a profit of 2 rupee. If you have valued it on mark to market basis, that's we usually value the derivatives on mark to market basis only. So you can transfer this 2 rupee in your P&L account. Then again it went up to 14 rupee. You can again transfer this 2 rupee to your profit and loss account. It went down directly to 8 rupee. Then there is a loss of 4 rupee. You can again transfer this loss of 4 rupee in your P&L account. That's nothing but mark to market. That is mark to market. That means if there is any kind of change in the value, you also need to change the value in your books of accounts and transfer that resulting gain or loss in your P&L account, right? That's mark to market. Here we can see the income from the derivative portfolio as well. So in March 2025, private sector banks are having the highest income from the derivative portfolios, right? The blue color is for the private sector banks. Okay. Then if I talk about the bottom up stress test, credit market and liquidity risk, the bottom up stress test for liquidity risk revealed that liquid asset ratios of all the sample banks would remain positive under the alternate shock scenario. So even if they are tested, even if they have tested the particular banks, right, a bunch of banks on the liquid asset ratio, then also they are doing well even in the stress scenario. So that's good again, right? Emphasizing the adequacy of the HQLS. So they are having high quality liquid assets to at least that level. Even if there is a stress scenario, they are able to tolerate it, right? Then comes the primary urban cooperative banks, right? UCBs. So credit extended by the primary urban cooperative banks registered a higher year-on-year growth at 7.4% in March 2025. Okay. The capital portion of the UCBs again continued to strengthen. So there was a strength in the capital positioning of the UCBs as well. Plus CRAR is again 18%, which is very well above the bare minimum requirement. If we talk about the GNPA and NNPA ratio of UCBs, both SUCB and NSUCB decreased significantly. So the ratios have gone down significantly, and decrease in the ratio of these NPA terms is good, right? PCR was also improved. So we can have a look at all the UCBs. 7.4%. SUCB and NSUCB both are almost same only, right? SUCB is having 0.1% more than the NSUCB, if I talk about the CRAR, it's again at a good level in an increasing trend, and NSUCB have outperformed in case of CRAR. You can have a look at the GNPA and NNPA ratios as well. They are quite low as compared to the earlier years, right? They have decreased substantially as compared to the earlier years. So that's again a good sign. Provisioning coverage ratio at 91%, PCR is at 91%, that's also fine. Then coming to NBFCs, the credit growth of NBFCs, both for upper and middle layer, rose to 20.7% year-on-year basis in March 2025. So there was acceleration in the credit growth. Definitely there was credit growth and was driven by NBFC upper layer. This particular growth was driven by the NBFC upper layer. Okay, so we can have a look at the credit growth. The total NBFC both upper layer and middle layer was, the growth was at 20.7%, and we can see a exceptional growth in the NBFC UL upper layer, 40.8%. That's enormous. That's enormous, which is quite high as compared to the middle layer, which was there at 13.4%. So please do remember this particular thing. This is the exceptional growth rate, right? Even if you compare it with other months, the growth is quite exceptional, right? The growth is quite exceptional in the March 2025. So please do remember this thing. This is important, right? Then I have given you guys here the chart of credit growth of select sectors as well. So you can have a look quickly कि कहाँ पे कौन से सेक्टर के अंदर ज़्यादा ग्रोथ हुई थी. There was a negative growth in the agriculture sector. Okay. If I total both upper layer and the middle layer NBFC, there was a negative growth in agriculture. Okay. Then the credit in the agriculture contracted. We have seen that the rate of credit expansion by the NBFC ML significantly declined across the sectors in 2025, except the other categories. Only the other category increased. Otherwise, in the middle layer, every category has shown a decline, right? The credit growth in the unsecured personal loan segment has slowed down significantly. Obviously, earlier the banks have increased the risk weights to NBFC lending, right? Gold loans, on the other hand, have clocked rapid growth since September 2023. So gold loans are at an all-time high as of now. Delinquency level in both NBFC UL and ML has improved, and NBFC ML have continued to maintain a higher PCR than the UL. So ML is able to maintain a higher PCR than UL, right? Then CRAR of the NBFCs were healthy at 25.8%. That's quite a good CRAR in March 2025. NBFC UL were consistently maintaining elevated NIM at around 8%. So UL ka NIM, net interest margin, was quite higher. Profitability of the UL was much higher than that of the ML. We have seen that as well in terms of both return on asset and equity. And on the liquidity front, the upper layer NBFCs were more vulnerable, given that they are having a higher portion of short-term liabilities to the total assets as comparison to the middle layer, right? So upper layer wali NBFCs ka higher exposure tha in the short-term liabilities, which makes them more vulnerable as compared to the middle level. Why? Because short-term liabilities ka payment bhi to short-term mein hota hai na, within 1 year, right? So that's a problem. So you can have a look at the capital adequacy ratio and profitability. This is an important chart. You can have a look at the ROE as well, ROA, NIM and CRAR as well, right? Then the reliance of the NBFCs of bank funding decreased over the last year as the impact of higher risk weights on bank lending to NBFC played out. So we already discussed this thing, that RBI has increased the risk weights for bank lending to NBFC. So because of that, NBFC portfolio quite shrinked a lot, right? So dependence on the NBFC UL on the bank borrowings and public deposits were higher than that of the NBFC ML. Obviously, the upper layer needs more money. So dependence on bank borrowings and public deposits were higher as compared to the ML. Again, they have conducted a stress test related to the credit risk on NBFCs as well. So they have taken a sample of 158 NBFCs over 1 year horizon for the assessing of the resilience, and it was quite good. Again, you can have a look at the NBFC source of funds as well. So here we can see that if overall I compare both upper layer and middle layer, right? So this is the borrowing from the bank, which is the highest number among all the borrowings. However, they have started borrowing from the debentures as well. By using their debentures as well, it has increased, right? So these are the two major borrowing sources of NBFCs, borrowing directly from bank and from debentures. Okay. Then there is another criteria of stress testing of mutual funds. We all know that SEBI has mandated earlier in 2024 that asset management companies, the mutual fund companies, should carry out a stress test of all the open-ended schemes. Open-ended means you can enter anytime. Sorry. So open-ended means they can enter anytime, anyone can enter anytime, and anyone can exit anytime as well. So we need to evaluate what if there are high redemptions from the mutual fund. So in case of that thing, whether the AMC will be passing the stress test or not, right? So in April 2025, the risk level of 43 open-ended debt schemes with total asset under management of 2.25 lakh crore was breached the AMFI or AMC prescribed the threshold, right? So they were breaching the limit which was prescribed by the AMFI. Okay. So if I talk about the total, so out of the total 48, only 31 were having risk below the threshold, otherwise 17 were crossing the risk. And if I talk about the number of schemes, then 43 were crossing the risk levels, right? 43 were crossing the risk levels. The AUM was 2.25 lakh crore, so that's huge. So again, there is a need to focus on the stress test, right? Better results on the stress test. If I compare, if I talk about the mutual funds, then again, liquidity risk management for open-ended debt scheme. Two types of liquidity ratios were used: LRRAR, LRCRAR. Okay. So these AMCs are mandated to require these liquidity ratios above the threshold limits, right? Derived from the scheme type. So we have seen that not all the AMCs, not all the schemes were able to pass the stress test. If I talk about the insurance sector, the major ratio that we talk always about in the insurance sector is the solvency ratio of an insurance company. What do you mean by solvency ratio? The excess of assets over the liability of the insurance company. We all know that insurance business is a high risk business. There can be multiple claims emanating from the claimants, right? From the claimants, and you can face the stress in that case if there are high amount of claims. So here the bare minimum IRDA has prescribed is 150. Okay, in the insurance sector, IRDAI is the insurance regulator. We all know that, right? Minimum solvency ratio prescribed by the IRDAI is 150%. That means your asset should be more than your liability by 150% at least. Okay, and you can have a look at the solvency ratio of the insurance sector as well. They all are more than 150 only. So that's fine. Okay, again the source is from the IRDAI. Then if I talk about the financial system network, then long-term loans continued to mainly provided by the scheduled commercial banks to the NBFC. We have already seen that still SCBs are providing long-term sources mainly to NBFCs. The secondary sources debentures, right? AMC MF continued to be the major investor in the equities issued by the private sector banks and the public by the NBFCs. So AMCs are the major investor. उनका काम ही यही है, देखो इन्वेस्ट करना है इसके अंदर. Then in the long-term debt market, insurance companies held majority of the instruments issued by the PVBs, NBFCs and HFCs. If I talk about the short-term funding, the interbank ST loans and deposits, CPs and CDs continued to be dominant. So short-term loans हो गए, आपके deposits हो गए, commercial paper, CDs, certificate of deposits, इनका ही main यहाँ पे dominance रहा था. Interbank market exposure stood at 3.4% of the total assets of the banking system in March, and PSBs continued to dominate the interbank market with more than 50% share. So in the interbank market, public sector banks are having a share of more than 50%. Please do remember this particular thing, right? Contrary to the dominance of the long-term fund-based exposure in the overall financial network, the interbank market continued to rely heavily on the short-term funding. So still the interbank market is heavily relying on the short-term funding to a tune of 77% of the fund-based interbank. We can here see the short-term fund-based facility is majorly dominant by the short-term loans, right? And here in the long-term fund facility, we can see that long-term loans are dominating the entire category. Then there is exposure of AMC's mutual fund. So the gross receivable of the AMC mutual fund, largest fund provider, this was the largest fund provider, stood at 20.68 lakh crore, right? So it was around 32% of the average AUM. And if I talk about the gross payable, it was just the 1.26 lakh crore. Exposure to the NBFC. So NBFCs were the largest net borrowers or fund from the financial system. So from the entire financial system, who have borrowed the largest, NBFCs have borrowed the largest amount of fund, right? The gross payables are 21.15 lakh crore against the gross receivable of just 2.26 lakh crore. And we can see these things in the charts as well, right? Next is your contagion analysis, right? So in this particular analysis, this uses the network technology to estimate the systemic importance of different financial institutions, and any kind of failure of a bank due to solvency or liquidity losses can lead to a widespread impact on the banking system as a whole. And this particular thing we have seen in 2008 crisis as well, right? So if I talk about the joint solvency, liquidity, this impact was hypothetical failure on the banks with the minimum capacity to cause the contagion losses would cause a solvency loss of 3.4% of the tier 1 capital of the SCBs and the liquidity loss of 0.3%. So they have just quantified it कि अगर ऐसा कोई सिनेरियो आता भी है, so उसके अंदर what can happen, right? उसके अंदर what can happen. Now NBFCs and HFCs among the largest borrower of the funds from the financial system with substantial part of funding from banks. Failure of any NBFC or HFC will definitely act as a solvency shock to their lenders because they are the largest borrowers out of the financial system. So definitely if when NBFC is failing, it can have a widespread impact on the banks as well. Hypothetical failure of NBFC with minimum capacity to cause solvency loss to the banking system would knock off 2.9% of the latest tier 1 capital. तो यहाँ पे 2.9% से tier 1 capital साफ हो सकती है, but it would not lead to any failure of any bank. So they have clearly specified that कि it will definitely have a good amount of impact. 2.9% का impact आ सकता है. However, इससे कोई भी बैंक fail नहीं होने वाला. There won't be any bank failure as of now because of failure of NBFC. Okay guys, thank you so much for watching this video. See you soon in the next session, chapter 3 of the Financial Stability Report. Bye bye, take care.